Was there one, or did they assign one? Let's bring in Bob Shea. He's the CEO and Chief Investment Officer at TrimTabs Asset Management. Bob, I love the first sentence of your notes because it addresses this topic, which is something we talked about here as well, that markets were already under some pressure before Yellen's comments. You point out that maybe it was just gravity at work.
Yeah. Hi, Oliver. I think that might just be the case. We had that drop, pre-open, and everyone was searching for why, which to me is an indication that it just felt like positioning might be a little offsides. The 10 days prior, we just couldn't get, we had a plethora of just incredibly good news between, fiscal and monetary support, as well as blowout earnings, particularly from the mega cap techs. And when my experience when, markets roll over on good news, it's typically just positioning.
So when we talk about a market being perhaps positioning too lopsided, and then companies like Amazon and Apple can't rally after these big beats, what's an investor to do, Bob?
Yeah, look, I think it just feels like a little pullback, which is natural after the run we've had. Listen, we've had a call for correction from a number of prominent strategists of late. The market usually doesn't reward, kind of consensus thinking right away, look, there's nothing wrong with the market. A pullback is natural. If you look, emerging markets were leading this rally, this year and fourth quarter of last year. They started trading down. That was kind of a nasty divergence. The VIX did not make a new low when with this most recent S&P high. Nothing dramatic, nothing over a very long term, that would indicate any kind of major top. But definitely, I think it's just literally, like I said in the note, just gravity. It also feels to me that some of the, kind of one-sided options positioning, going back to my Goldman Sachs.com days, my ear is kind of attuned to sentiment, whether it's riding the train home, listening to folks talk about their internet exposure, to skiing in March and listening to kids landing jumps, talking about game stopping it, to more recently, some folks like my children and some more amateur investors talking about some crypto and Dogecoin. So it just feels like some of the speculative element has moved from the stock market into perhaps crypto. The one-sided weekly call option, that was really tilted in some of the tech names and speculative names moved to crypto.
Bob, let's talk a little bit more about the dot-com comparison. It seems impossible to ignore when almost every valuation measure is at an all-time high, and we are dealing with Dogecoin worth $90 billion in market cap. And this is bigger than half the companies in the S&P 500. How does this period we're in, where people have memified the stock market into a stocks only go up environment for the last 6 months, how do we go from stocks only go up to some stocks go up or some stocks go sideways? Doesn't .com tell us that we go from stocks only go up to stocks only go down?
Good point. Yes, there are a lot of similarities between this time and last. I think what's different is the interest rate environment. Well, all this talk about inflation and interest rates, we're at 1.6% versus 5 and change percent back then. I think with easy money and stimulus checks, you get pockets of exuberance. But with regards to the bond market and the riskless rate, it's a very, very different environment. We focus on free cash flow at TrimTabs, and just looking at free cash flow backdrop of the NASDAQ 100 back in 2000 to now, a very, very dramatic difference, much healthier. Yes, stocks are the high end of traditional valuation, but based on where interest rates are, it's still it's still pretty reasonable. I think this is a pullback, nothing more, just based on positioning and just like I said earlier, a plethora of really good news that gravity just stopped the upward momentum. In many ways, it seems kind of funny that we even talk about
small of a pullback as we've gotten here with the S&P, literally just a couple days off a record. But to me, that suggests again that we've got such high expectations in this market, where we've been watching just everything make highs and trending higher for so long. Bob, what do you look for as a way to assess over time if the risk is heightening? I mean, from a fundamental perspective, it seems like you watch the bond market and inflation as one of those risk points. But what about just from a defrothing standpoint? I mean, do we have to now become trend and technical analysts? What will we be looking for to test over the coming weeks the health of this rally?
Yeah, it's a good question. For me, meaningful tops or real inflection points have typically glaring divergences. And for me, I would look at spreads, which have been near record tights. No real big divergences there. There's obviously with we have different velocities of reopening. All this talk about how hot the economy is. I think I talked to you about in my notes about the City Economic Surprise Index, which peaked in July and has kind of rolled over consistently in the U.S. So does that mean economic data is bad? No, it just means it's not beating expectations to the extent it was in the back half of last year. For me, I look for big, meaningful divergences. We haven't seen any of those. I think, earlier this year, we saw the real one-sided short-term options positioning. I tend to look for that as an indication. Retail buy to open options positioning being really, really lopsided. That has really abated over the last several weeks. As I mentioned earlier, folks moving some of the speculation into the crypto markets. And look, I think what we're seeing more is kind of violent rotations than an overall correction. Everyone's looking for a reason why tech's rolling over. Interest rates surely aren't the reason. If you look, we've been chopping. We had that strong move from 55 basis points to 170, and that delta really affected the technology space, or the bigger technology that are more sensitive, long duration assets. But I think where interest rates are, I think tech could be just fine. And in our research, where we focus on free cash flow profitability, and in our strategies, we go where the free cash flow is. Technology still screens incredibly well from a free cash flow perspective.